Welcome to The Explainer. Today, we are unpacking the ultimate regulatory fail-safes, specifically systemic risk management in the insurance sector. We're going to examine the exact compliance frameworks that regulators use to monitor massive financial institutions, basically making sure the safety nets we rely on don't suddenly morph into systemic threats.
So, could a single insurance company literally bring down the entire global financial system? I know, it sounds a bit like a movie plot. But in our highly interconnected global economy, it's a very real regulatory nightmare. We're talking about a massive domino effect here. If one colossal piece falls, the shockwaves can knock over everything else in its path. Just think back to the 2008 crisis. We saw a single insurance giant require a staggering $182 billion bailout just to prevent a total global financial collapse.
Okay, let's dive into this with Section 1, Understanding Systemic Risk.
You see, regulators specifically designate certain organizations as systemically important financial institutions. These are entities engaged in non-traditional activities that are highly vulnerable to financial market developments, and frankly, they're the ones likely to amplify systemic risk. Because of this very specific designation, they require intense, continuous oversight. We're not talking about your standard everyday insurance providers here. These are literal load-bearing pillars of the global financial market.
Let's move to Section 2 and see how this builds: size, interconnectedness, and complexity. The threats really stem from three primary drivers: unprecedented size, deep interconnectedness, and structural complexity. Think about it. When a company is massive, deeply woven into the fabric of other markets, and structured so opaquely that it's incredibly difficult to untangle, well, an isolated failure simply doesn't stay isolated. It triggers an immediate chain reaction. The dominoes start falling fast, and the effects ripple across borders and industries at a truly terrifying speed.
Which brings us to Section 3, the threat of non-traditional activities. Not all insurance activities are created equal when we're talking about financial contagion.
And this brilliantly illustrates that stark divide. On one hand, you have traditional insurance, pooling risk for property, life, and casualty. That actually stabilizes the market. But on the other hand, systemic, non-insurance activities, like complex credit default swaps and debt securities insurance, do the exact opposite. They don't pool risk at all, they actually amplify it.
The real danger with these non-traditional activities is that they cause dangerous liquidity transformation and leverage. What does that mean for you and me? Well, when an institution takes short-term liquid liabilities and turns them into long-term illiquid assets, that's what we call maturity transformation. Add in an imperfect transfer of credit risk, and suddenly, if the market shifts unexpectedly, that institution might not have the cash on hand to actually meet its obligations. And when these giants freeze up, the credit markets freeze up right along with them, completely infecting the wider economy.
Now let's shift gears to Section 4, Key Risk Exposure Metrics, and see how regulators actually monitor these massive institutions.
To navigate this danger, just take a look at these SASB standards for systemic risk management metrics. The Sustainability Accounting Standards Board has created a clear, standardized framework specifically for measuring this exact kind of exposure in the insurance sector. It essentially gives regulators and investors a universal, transparent language to assess the threat level and enforce compliance.
Now, what's really interesting about this slide is how the standard breaks that monumental task down into three highly specific accounting metrics. First, metric FNIN 550A.1 tracks exposure to derivative instruments. Then, 550A.2 looks at the fair value of securities lending collateral. And finally, 550A.3 focuses on how capital and liquidity risks are actively managed. Let's walk through exactly what each of these requires. Starting with derivative exposure reporting. Institutions must detail their total exposure to non-centrally cleared derivatives, which are essentially private over-the-counter agreements. Then, they have to report the fair value of acceptable collateral posted with a central clearinghouse. And third, they report total exposure to centrally cleared derivatives. This separation is absolutely vital. Why? Because non-centrally cleared derivatives carry a much higher counterparty risk, and regulators need to see exactly where that risk is hiding.
Next up is the collateral from securities lending. Whatever assets the institution is reinvesting collateral into, they must report the total fair value, regardless of the maturity date. This includes real estate, mortgage loans, bonds, equities, swaps, forward contracts, and of course, cash. Full transparency across the board is absolutely non-negotiable here to prevent any hidden vulnerabilities from festering off the balance sheet.
Moving on to Section 5, Planning for Orderly Dissolution. let's slow down a bit here to look at the ultimate regulatory fail-safes.
This is where central banking systems step in with stricter prudential regulatory standards. Because these institutions are systemically important, they face strict limits on risk-based capital, hard caps on financial leverage, uncompromising limits on credit exposure, and mandated liquidity thresholds. Regulators impose these tight operational limits to act as fire breaks, stopping financial contagion before a tiny spark becomes a global forest fire.
So the crucial point is this. Regulators may require entities to maintain a plan for rapid and orderly dissolution in the event of financial distress. Let that sink in for a second. These entities are so complex and so heavily intertwined that regulators legally mandate they have a step-by-step blueprint for their own destruction. It's essentially a controlled demolition plan for a financial giant, ensuring that if they go down, they don't take the rest of the global economy down with them.
But, institutions can't just have a dissolution plan sitting on paper. They must actively prove they can handle sudden market movements to avoid ever actually needing it. They do this through aggressive stress testing, concrete contingency planning for stress situations, and demonstrating true responsiveness within their enterprise risk management or ERM frameworks. They have to prove without a doubt that they can survive sudden collateral calls or mark-to-market changes without totally collapsing.
Ultimately, transparency and preparation are the only ways to prevent the next financial crisis. Tracking these complex SASB metrics isn't just about some regulatory box-checking exercise. It is literally the only way to prevent the next global contagion. But as financial instruments become increasingly abstract and opaque, we have to ask ourselves, are our tracking mechanisms evolving fast enough to catch the next systemic threat before that first domino falls? It's definitely something to think about. Thanks for joining me on this explainer.